Hello guys, and welcome to the beginning module of Project 3. This is going to be about understanding options. This is the first of many in this different, series of videos, and we're going to start from beginner and go to more advanced type of teachings as we go throughout the video. So obviously this is the first video. It's going to be in order. So this is going to be the most beginner friendly and basically for complete beginners, but I'm going to touch on a few different topics and frameworks as to how I look at these simplified things in my own way based off of all the experience and knowledge that I have. So a quick overview about me, if you don't know, is I've been trading options for 6 years now in the stock market, and I've been teaching people how to trade options for about 3 to 4 years now. So connection restored. So in this video, I'm going to be going over exactly how you can start understanding options, all the simple stuff in a simple way so that you can digest it and walk away from this video actually knowing something and knowing if this is what it is that you would like to pursue or do. As I always tell you guys, I do the hybrid model. I do not recommend that you just trade options and not have a cash flow based business model. I do recommend that if this is something that you're really passionate about and want to do in life, that you start to learn about it and start to actually take action upon it while you have that cash flow business. So first things first, this is not an easy business model at all. I want you guys to understand that trading options is probably the most difficult business model there is, but it's the easiest money. There's a quote that says, options is the easiest money but the hardest money to make, if that makes sense. You can trade options completely remote. That's one, very, very great variable of options is you can be in Dubai, you can be in Shanghai, you can be in Bali, you can be in Thailand, you could be in London, you could be wherever you want to be, and you can trade the US stock market from a hotel, from a coffee shop, from anywhere you want to be. It's completely remote, and you're the only player in the game. It's literally you versus the markets. That's what you have to understand. It's you versus the markets, nobody else. Obviously, you're going against other people who are trading as well, but you guys get the point. So let's just get into the simplistics before I go on too long. Okay, understanding options. First thing right here, a stock. For those of you who don't know, a stock is simply a security, is what we like to call it, a company. So Tesla, that's an example of a stock. Apple, Nvidia, so on and so forth. What options is basically trading the derivative of that stock. Derivative meaning derived from. What this means is that when you're trading an option, it's basically you're either trading calls or puts, as we have right here. And what a call is betting that a stock will go up. And what a put is betting that a stock will go down. But when you buy a stock, you're buying a stock, for example, Tesla shares. You can buy one share of Tesla for $215. And if the share, or if the stock price of Tesla, goes to $217, then you made $2 in profit. But if you bought an option contract, a call contract, let's just say, for a 220 call on Tesla, and you're basically betting that Tesla is going to go up and the strike price is 220, which is basically you saying that you predict that it could go to that price. So the amount of money that you're going to make in comparison to you investing in a stock versus investing into an options contract is based off the delta, which is going to be later in this video. So an average delta, we'll say, is 0.40. You always multiply everything in options, not everything, but obviously you guys, it's hard to explain because I can't show you an actual example in this video, but for example, you want to multiply it by 100. So 0.40 is going to be the delta. And what the delta is the estimated price increase or fluctuation that contract will change if the stock price increases by $1. So we're multiplying 0.40 by 100, which is going to give us $40. So when we do this, we now understand that buying one, contract of these calls, if Tesla goes from 215 to 216 and we bought a 220 call, for example, we bought the 220 call for $200, and Tesla goes from 215, which is when we bought that call, to 216, we can probably estimate that we're going to make $40 in profit if we bought one contract from that one call. One contract, $40 profit. The stock only moved up $1. So you guys are already getting the understanding of how this is much more leveraged and how you can make much more money than just investing into a stock. And you guys are probably thinking, wow, it only has to move $1 in my favor and I'm able to make $40 when I'm basically investing the same amount of money. That is true, but also you have to realize that you can lose, and you do lose. Practically, it's all an estimate based off everything that's happening in the market, but around that same amount if the stock price goes down $1. So it's not just like, oh, it's so easy money, you make, it moves $1 and you make this much, but if it goes down, you're not going to lose. Both sides of the equation have around the same exact level of risk to them. That's just how the game works. Now, we're going to get into more right here. So, as I already explained, you know what a stock is now. Calls is betting that the stock is going to go up, and puts is betting that the stock is going to go down. So, let's go right over here. Let me click. Okay. Why trade options and not stocks? Now, there's nothing wrong with trading stocks, but this is something that is going to be a lot more capital intensive. If you're trading stocks, I don't recommend trading stocks if you have $5,000, $10,000. I mean, if you're putting in $5,000, $10,000 into, a stock and then trying to make that money, you might make a few $1,000s in profit, but that isn't really going to do much for you comparative to what it could do with options. Trading stocks, as you probably see, a lot of these big traders, Julian Petrolis, Umar Ashraf, these people have extreme amounts of capital that they're putting into a trade. They have extreme amounts of equity in that trade, which allows, if they get a 30% return on investment, which is a great return on investment, they're investing, $3 million in making, $950,000, $1 million in profit. You're investing $10,000, you get a 30% return, and you're making $3,000. And that takes up a lot of time. This isn't a day trade. For a stock to move 30% and you be in profit 30%, the company has increased tremendously, and the value of that stock has, gone up tremendously. It's not going to happen in one day, which is very, very highly unlikely, unless you're obviously trading penny stocks, which is different. But most of you guys watching this, you don't have, a few $1,000,000 to allocate into an investment. That's why I don't say, oh, go trade stocks, or, oh, go trade, get into these different equity plays or long-term investments if you don't have the capital for it. Everybody in this industry, especially the trading industry, and I see so many young people trying to get into it, they do it wrong because they're going into it following the frameworks of these people who have millions and millions to invest. A lot of the traders that you look up to have millions and millions of dollars to invest. That's why they're so much further ahead than you. But you're able to get to that point by using this strategy. So, why trade options and not stocks? So, speed of ROI. Speed of ROI is basically how I explained in the first step, the delta, example, and how you're able to basically use options to make a lot more money faster. But also remember, I'm always going to stress the fact that you can also lose a lot of money a lot faster. Both sides of the sword. You have to understand that. So, like I said, you have to be able to know that when you're trading these contracts and you're getting into these different positions, you're able to make a lot of money, but you're also able to lose a lot of money. Leveraging smaller cash for larger returns. You don't have to be taking on, a $50,000 position to be able to make, that $5,000 in profit. Honestly, the amount of investment that you have to put into a trade is a lot lower than what you would think. So I would say when trading options, depending on the contracts you trade, it's all different because of the different variables. There's a lot of different variables. This is something that I have to make multiple videos on. But when you're trading, for example, 0 DTE contracts, which is 0 days till expiration contracts, that percentage or return on investment that you're getting in that position will fluctuate a lot quicker than, for example, a contract that expires at the end of the week or 2 weeks out, because it's so close to expiration, which means that there's, it's basically going to expire that same day. And you have to understand that the closer the expiration is, the riskier the trade is. But also, you're able to make a lot more money faster. So with these option trades, for example, 0 DTE, since we're on the topic of it, it's very, very common to see, for example, a 30% or 40% return within even, 2 minutes. That's how easy it is. 2 minutes. Same thing goes for the downside. I need you guys to understand that. That's why risk management is a huge factor in this. But the point that I'm trying to make is, if you're investing $10,000 and you're able to get a 40% return in 2 minutes, and you're able to do that consistently day over day over day over day, if you do that three times in a month, you're making $12K profit a month. So you have to realize that the skill is what needs to be mastered. That's what you have to realize. And this whole entire industry, this whole entire, business of trading options is a lot harder than you think, but you're able to leverage smaller cash for larger returns. If you wanted to get that 40% return on investment just by investing in a stock every single day, you can't really do that by just investing into, an equity play where you're putting in all this capital into Tesla. The game with, larger position sizing and investing in stocks is not about the actual, dollar amount. It's more about, sorry, that was kind of weird. The whole point of trading equities is putting in a large amount of capital in order to get that return on investment that does not need to be 40%. They're not aiming for a 40% return on investment unless it's extremely long term. Most of these people are fine with getting 7, 8, 6% return on investment. You are going to have to be able to realize that the amount of leverage when you're trading options is going to be much, much, much higher. Much higher. Next one, active, not passive. So basically, investing in, different companies and just waiting it out, or investing in crypto, the whole consensus is just buy and wait. Me personally, with long-term investments, it's never been a thing where I check them every day. I just put the money and wait, and I'm making money. That's actual passive income. I rarely ever say, okay, this is passive income, blah, blah, blah. But investing your money into a stock and just waiting is literally the easiest, genuine passive income, in crypto too, because you're just putting your money into something and literally not doing anything. And as long as you believe in it, you're not really worried if it goes down. But with trading options, this is something where you, like I say, you can go out into the market every single day, and it's up to you whether you want to eat that day or starve that day. You're able to go into the market every single day and have that potential to make X amount of money based on the amount of risk that you're willing to take on. So you can say, I woke up this morning and I want to take a trade, I want to take a trade, I want to take a trade. And you have that potential every single day to make 30%, 40%, 60%, over 100%, high percentile ranges every single day based off the amount of risk you're willing to take on. And obviously, as your capital increases, as your position size increases, then you're going to see more and more money coming in. But this is something where you're able to get after it every single day, which is another beneficial thing, Monday through Friday. Brokerages. So if you've got to this point and you're telling yourself, okay, I like what this, could be for me. I want to try it out. This is something that I want to do. Like I said to you guys, this is one of the hardest businesses that you'll ever get into, ever. So I'm not telling you to get into it. I'm just making this for the people who want to get into it. The point being is that if you've decided that you want to get into it, here are the brokerages that you can start with. So if you're a beginner, Robinhood and Webull both work. I mean, you're able to easily understand the interface pretty simply. It's literally just an app on your phone. But I would always actually recommend, as a beginner, you at least get Robinhood and Webull, just so that you can, look on your phone when the market's closed and you're kind of getting familiar with different stocks and stuff like that. But once you're actually taking trades with real money, you want to be kind of already taking trades in this advanced section, which is Thinkorswim and Tasty Trade. As most of you know, Tasty Trade, the name changed, but it used to be Tasty Works. But the point being is that you don't want to be, always trading on Robinhood or Webull, especially once you're taking larger position sizes. I've made that mistake before, where I was just, out of town. I was just like, let me just get on my phone, or I'm in the car and I'm just like, let me get on my phone and take a quick trade, make some quick profit in and out of the trade. But, it really gets bad, and you'll understand once you get into this whole trading thing, because the speed of execution and how fast you're able to get in and out of trades is very, very bad on these beginner platforms. Now, I'm pretty sure that Robinhood is coming out with a new online interface or something like that, but personally, Thinkorswim is my favorite. So if you are not familiar with it, I would recommend that you start to get familiar with Thinkorswim, and I'm going to make a video as well explaining that. So that's, as far as the brokerages that you should choose. Next, avoid with your life. These are the keys you need to understand. Prop firms. Do not start out trading with a prop firm, or ever trade with a prop firm at all. I'm not going to go fully in depth into this whole prop firm thing in my video right now, but I'm going to make a completely separate video as to why I believe prop firms are just a scam. Like, stay away from prop firms with your whole life and never ever get into trading with prop firms. It's just the worst decision that you can ever make. And I genuinely think that people who go into trading and go right into trading, or even get into trading and go with a prop firm, when people start trading and go with the prop firm, it's the worst mistake, because their whole entire trading psychology is ruined. Everything that they think trading is completely differentiated from the actual reality, and their skill set just won't be up to par for what it should be, based off so many different factors. So I think that if someone just goes right into it and goes into it with a prop firm, which is basically a company that gives you a certain amount of capital for a profit split, they're literally like destroying them ever possibly being able to understand what trading actually is. And this stains people and makes them like just avoid the industry forever, because it's such a scam. It's so wrong in so many ways. So stay away from prop firms if you want to take my word for it. If you don't, you do you. Starting with large size. This is a big mistake. I talked about how fast you can get these big returns, 40%, 50%, 60%. So when a lot of people hear that, they say, yep, 20K right into the account, ASAP deposited. Let's go. Tesla 0 DTE. First morning, Monday, wake up, boom. I'm in the trade, full position size, 20,000, boom. Lost 100% of the trade because I didn't know what I was doing. Boom. Again, maybe I just messed up on this one. Let me get into another one. Deposits 10,000 more that they, saved up for so long, thinking that they're going to make it back, double up. This is where the cycle really gets bad. Really gets bad. This is an extremely hard thing. Is in the beginning phases, you have to have extreme discipline to understand the fact that you need to start out with small position size. I don't care if it's boring. I don't care if you want to instantly get at the highest level of trading. You have to start off with small position size, or else you will literally have a terrible start. You'll probably blow a lot of money that you've saved up. your whole entire life. And you'll be reinvesting all the money from your job, and you'll just keep on losing. So invest a small amount of money. Like, you know, invest what you can lose is what I always say, because more than likely 99% of people, it happened to me, it happened to, you know, some of the best traders I know, and people who are extremely successful with trading right now currently, everybody loses their whole entire initial first deposit of what they put into their portfolio. Usually it's not like you're going to invest, you know, $2,000 and then you're going to come out with $5,000, but likely you will, you know, turn it into a large amount and then lose it all. That's just how, you know, the game works. If you get into trading and you don't fully blow your entire account within the first month or two, then it's surprising. Honestly, it is surprising. This is just the reality. I'm not here to lie to you guys or sell you on anything. That's just the reality of this game. That's why I don't tell people, oh, get into trading. Oh, you know, this is what you need to do, because it's super, super, super difficult. That's the truth. So, you know, be careful regarding that aspect. Next, 0 DTE. So we talked about this 0 days till expiration. We're not going to talk too much about it. This is just the riskiest expiration contracts that you can take. Basically the highest risk contracts that you can trade. So if you're a beginner, just avoid. This is all about, you know, except for the prop firm part, because never, even if you're advanced, would I ever touch that. Prop firms, it's just stupid. Starting with large size, that's for beginners, and 0 DTE, that's for beginners as well. You can trade 0 DTE later on, you know, once you're more advanced and you start to, you know, understand. But 0 DTE, stay away if you're a beginner. Capital deployment and management. So, like I was talking about, let's figure out how much money that we want to actually put into our portfolio or use to fund our portfolio. So, when you're, you know, funding your portfolio funding, you want to be able to put in an amount of money that you're able to lose. You can lose all of it. So think of it like you're likely going to, you know, use this amount of money that you invest as tuition to learning. That's just how the game works once again. So you need to be able to lose in order to eventually win. So a good amount, and the exact, you know, sweet spot amount that I always say is $2,000 to $3,000 initial deposit is like how much you want your portfolio to be. Do not go full position size. When you're putting in that $2,000 to $3,000, you're putting it in order to, you know, test out what it is that you need to work on and everything like that. You're not even trading yet. This is after, you know, you taken paper trades, you've been watching the markets for a while and understanding how everything works. And you have that $2,000 to $3,000 portfolio in order to start learning. So you're not taking a $1,000 position size. That's way later on. You're starting out by taking, you know, $150, $300 maximum per $150 to $300 maximum position size per trade, because you don't want to over leverage or risk too much. And then within that, you want to set that stop loss at whatever you're comfortable with losing. So if it's 20%, you know, and you're taking that $300 position size, you're able to lose $60 per trade, and you might be aiming to make $120 per trade. So that's your risk tolerance. But the whole point of this $2,000 to $3,000 is seeing, okay, I'm able to manage risk well, or I'm just shit at managing risk, or I'm good at trading these specific companies, so I'm going to stick to this, blah, blah, blah. You guys get it. But usually you always want to stick to taking position sizes around 5 to 10% of your portfolio size at the smaller stages. And it just depends on, you know, the more you know and the longer that you've been in the industry. But obviously, if you have a multiple $100,000, you know, account size, you don't need to be technically doing that in every single trade, or some trades you might even take on more risk. But this is just for the beginners. So that was us covering also the deployment ratio, risk tolerance, and edge The edge is basically, like I talked about, finding out what it is that you're actually good at, knowledgeable about, what it is that your strengths and weaknesses are. As I always talk about in every business, the measurable phase, understanding what it is that you need to change or alter in order to become better and make more money in that industry. Next and finally, the key Greek, full Greeks continued. So the Greeks of options there's multiple different Greeks of options, but the key is understanding the delta. This is like my favorite one that I like to talk about because it helps you understand what option contract that you want to pick. And yeah, basically that's it. We talked about it already. So what the delta is basically an estimate of how much money that you'll make if the stock moves $1. So if the delta is 0.50, you multiply that by 100 because an option contract is basically 100 shares. So you multiply it by 100 and that will give you $50. So if the stock price moves $1, in your favor, then you'll make an estimated $50. That's not including IV and all that other different stuff. But $50 for a dollar move in your favor. For example, if you buy calls and the stock price goes up $1, then the estimate that you'll make is $50 if you bought one contract. So you want to avoid the contracts that are like way, way too low in delta. And you'll be able to tell when you're looking on Thinkorswim or any different platform, what the delta is. Stay away from those super low delta contracts because sometimes I've made that mistake where I'm like, this is literally like the price has gone up, but the delta was just so low that I wasn't even making anything. And then it's like once that trade goes against you, then it's like you just wasted a whole entire trade, and then your mental capacity is just like, I was right about the trade, but I just picked the wrong contract. So that's one of the dumbest mistakes that you guys have to avoid as well. Understand the delta, guys. We'll get more into depth about all of these different things, but that's really it for today's video or module, whatever you want to call it. We went over a lot of beginner things in different ways to help you guys understand how to properly understand options, how to look at options. I recommend that you guys take everything that I say and apply them slowly. Don't just go into this instantly rushing it. This, business is what I like to call it. It will take you a very long time to master completely. Tens of years. I have not mastered trading options. Sure, I might be good at trading options. I might be, above average. I don't want to, act like I'm the best options trader there is. But the point being is that you're always learning. You're always a student of the game. You get into this not, to make quick money, but this is something that you want to learn. And this is the most valuable skill that I've ever learned. This has taught me so much about business. This has taught me so much about how money works, so much about investing, so much about money management, risk management. Options has taught me every single thing that I know about business in the harshest ways possible and in the best ways possible that I needed to learn in order to become who I am as an entrepreneur. Options does not just teach you about how to trade stocks. It teaches you so much about how you can become, successful and what it is that you need to apply in life and all these different mindsets, frameworks. So when I started this at 14 and it's been 6 years now because now I'm 20, 5-6 years. The point is that every single day that I've traded and every single day that I've learned, mistakes that I've made, it has all accumulated and all been worth it. The losses have been worth it. Even the days where I would break even have been worth it. Every single thing that I've learned from this has been worth it. So don't look at this as, I want to get rich quick from this, blah, 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 because there's so much more to it. There's so much more to this game than you think. And please, guys, take it slow. Don't get in and burn yourself instantly and never look back, because the people that stick with this industry usually become extremely, extremely successful, whether it's in this business itself or in another field. Because if you're able to master this industry, I'm telling you guys that you'll crush in basically any other industry that you ever want to get into, whether that's e-com, whatever it is, because of your pain tolerance and your ability to manage money, understand how money works, and everything like that. So this was just the first module, and I'll see you guys in the next one.